Johnnie Roberts, welcome back to this mini series that we are doing on guaranteed income for life and specifically around this product thing called annuities. How are you doing this week?
Doing very well, man. How you doing, Mike?
I'm doing marvelous. Hey, let's go back to your early high school years when you were driving, just learning how to drive a car and things. Did you ever have any like passengers, any riders, people who rode along with you when you were tooling around town?
When I was going
I mean,
through the driver's training or
no, no,
whenever
no, no. After you got your license,
yeah,
you're kind of
no,
out on your own.
absolutely. My 1982 Cutlass Sierra that I bought
Yeah.
for 500 bucks. Yeah, we had people get in there. You know something
Yeah.
funny about that car real quick? And you can
Yeah.
ask me that question, but
Absolutely.
it, we had to put a radio in it because it didn't even, me and my dad went to this auto auction in Flint, Michigan and bought it for 500 bucks. But it didn't have the end. We had to put this radio in it, and to turn the radio on, you actually had to put it. We had to get a toggle switch. So you flip up this toggle switch so that the radio would work.
I love it.
It did have a
Yep.
cassette player in it, but yeah,
Yep.
it was
Oh,
for
I
five
remember the
hundred
days.
bucks. And it was pretty nice, man. It ran a few years.
That's good. That's a good investment there. Well, the reason I talk about that in riders and in cars and things, because we all have passengers and things, but we're in this mini series talking about annuities. And the last couple of episodes have been really good, but we're going to talk about a rider with an annuity and how annuities actually pay out. And that's what I was trying to make a connection between riders in cars and riders on annuities. I don't know if that worked because we've got this vehicle theme going on. But talk about now in this episode, we've got the accumulation side of an annuity, how it grows. We talked about how it indexes with the stock market and different things of that nature. You can go back to the last episode and listen to that. Today, let's talk about how actually pay out because that's the beautiful part of an annuity.
Yeah, so like you said, the last we kind of talked about guaranteed incomes, and we talked a little bit about like why don't people like annuities? Well, there's all these fees. Well, generally, that's you're going to have a fee for sure in a variable annuity because it ties into the market and all that kind of stuff and that kind of thing. And we talked about fixed and fixed index, which some of the basic, the most of them have zero fees whatsoever. So you have
Mhm.
zero fees. You have caps and all that kind of stuff we talked about that you can make up to this amount, and you'll never lose your money. And then we'll maybe get into how the surrender charge and all that kind of stuff works as we continue on through this. But now, okay, annuities pay out when you annuitize them generally. That was the traditional way an annuity pays out. You have it during the lifetime. There's a certain age where you can annuitize it, and the company says, based on when you first started it, we've given you this interest that we've guaranteed you during this time. And now when you annuitize it, this is how much money you're going to get for, you can pick, a 10 pay, I'm going to get this amount of money for 10 years and then it's done, or I can get it for the rest of my life, whatever. On fixed index annuities, some of them come with an income benefit, a guaranteed income benefit. Now, there's a few places where there's no fees, and then there's other places where you could pay 0.5%, 1%, 1.15%. What are the fees for? They're to give you a higher guaranteed income stream rest of your life, and the fees come out of the actual account value. Let's kind of break it down. The
Okay.
ones with no fees, you have your accumulation value. So let's say it's $100,000. I'm going to put $100,000 into this annuity, whether you write a check or you roll it over from an IRA or whatever. I got $100,000. So that $100,000 is going to grow based on the index strategies, which is what
Okay.
we're about. So the income part of this is there's also an income account.
Okay.
So most of these companies will say, okay, then we're going to take this $100,000. Your income isn't going to be based on that. Your income is going to be based on this income account. So we're going to give you credit from day one. Some are 15, some are up to 50%. So we're
Wow.
going to turn this 100,000 into 150,000. That's
Okay.
not the money that's your account value, but that's what we're going to base what we're going to pay you out a lifetime income from.
Okay.
Okay. That number. So we have our income account. So they give you a big kicker up front and say you have a 5 years, 6 years. You don't have to wait to annuitize to use these income riders.
Mm-hmm.
Okay. So if you have one with no fees, you and the income accounts, some of them have guaranteed growth patterns. Some of them say, okay, you can participate at a higher rate or whatever, but you'll never lose it. But bottom line, say your income account turns into $200,000.
Okay.
6 years later, I've got $200,000. I'm ready to turn on my income. I'm 68. turned on my Social Security last year. Now I'm going to utilize this annuity to provide me another income stream. So the ones that don't have fees have a payout factor, a percentage they're going to pay you out of that 200,000 that generally is smaller than if you have a fee. So we'll use an example, 5%.
Okay.
So they're going to say, we're going to pay you 5%. It's all dependent upon your age. So the older
All
you
right.
get, the higher that payout factor is. Well, just
That
use
makes sense.
5%. We're going to pay you $10,000 a year forever. Okay. So it's based on that income account. It's based on what it is when you
Got it.
turn the income on. Now, what's
Okay.
going to happen? You're taking out $10,000 a year, $10,000 a year. And if you are generally that kind of payout factor, you might be 63.
Okay.
So in 20 years, obviously, the money would be gone, right?
Right.
10,000 times 20 is but what happens is you still get paid that $10,000.
Mm-hmm.
Okay. You're getting that income stream for life. So on a free, no fee income stream annuity, fixed index annuity with an income account that has this income benefit on it,
Right.
the payout factors are lower.
Okay.
They still do the same thing as far as paying you forever, but there's not as much, there's no fee involved with it.
Right.
Why would I pay a fee for? What's the purpose of that? Well, what the fee is when you pay a fee for an income rider, it's designed to pay you a higher income stream and a higher income payout than the ones
Right.
that don't have fees.
Yep.
So say the fee's 1%. So what happens is this $100,000, say they give you the bonus of, I don't know, 15% or say 20%. So now it's worth 140,000. I have 100,000 in my regular account,
Mm-hmm.
but 140 is what my income is going to be based on.
Okay.
And because I'm purchasing this annuity or rolling money into this annuity for that purpose, for the income stream, that's really what I'm zeroed in on.
Okay.
My income account.
Right.
So, okay, 140,000. What does that rider do for you? Well, now they're going to say, we're going to guarantee you for the next 10 years, 5 years, whatever it is in that particular contract, that we're going to grow that by 8% every single year, no matter what. No matter what your account value does, your account value can never go down. Your account value is more for death benefit purposes
Okay.
generally. But and if you want to take other withdrawals out of, but we'll talk about that later. But the account value is not guaranteed to grow at 8, but this is. The
Okay.
account value could outperform it if you have higher caps, but for income purposes, you're going to grow by 8%. So over the next 5 or 6 years, 7 years, whatever it is, I'm turning 70 years old now, and I've seen that income account go by 8% every single year. So now we'll just use we'll use the same number we did before. It's worth 200,000.
Okay.
So I've got a guaranteed roll up on that. Now, what's the difference? Now my payout factor I've seen them up at that age, 7.5, 7.75, 8%, even above 8%, depending on the age. But now I'm going to get 8% of that $200,000
Okay.
paid out forever.
Okay.
So instead of getting 10,000 a year, I'm getting 16.
Okay.
And that 16 is like a pension now. I'm getting it forever.
Wow.
Because obviously, if you're taking money out of your annuity or any financial product, it's going to go down.
Right.
So it's going to go down, you'll get interest, and it's going to go down and so forth, right? So, but when it does reach zero, because eventually it will, because you're taking so much out of it,
Right.
you are still going to get paid that $16,000 a year. So you
Right.
never have to worry about that. And you can set it up if you're married on a joint level. What does joint mean? Instead of them paying out 8, maybe the payout 7 or what the payout's a little less, but
Right.
because instead of paying just you and you die and it's gone, now they're going to pay your spouse.
Right.
So you can do this guaranteed income for your household
Wow.
for as long as you live. And most of these products, a lot of them, you can start after 12 months. So
Hmm.
you could turn on that income stream. So I get my little bonus, I get my 8% roll up or whatever on that income account. I want income in a year. You're not going to find that. If you're getting a 15% bonus plus 8%, that's 23% growth on your money. You're not going to find that guaranteed in the market or anything, or that I can tell you, hey, in 12 months, that income account's going to be worth this much money.
Right.
and we're going to pay you out a percentage out of that account based on the highest dollar that it's worth forever.
Yeah.
If your money's just in the market, I got 123, it did go up 23%. I got 123,000 in there. Okay, I'm going to start drawing down 8%. That's cool. But if you don't make more of like 10%,
Right.
you're not going to get back up to it.
That's right.
And if you lose 10%, your 8% of 90,000 is less than, you know,
That's right.
8% of
Well,
123.
and that's one of the beautiful things about
That's
fixed
what the
index
income
annuity.
benefit does. That's why you pay that 1% fee. And most of the time, it's just during the surrender period of the policy.
Yeah.
It could be 10 years or whatever.
Yeah.
But what does it buy you? That peace of mind, that guaranteed income. And so we try to look for people for products that, yeah, sometimes they have a fee on them, but that fee provides you phenomenal benefits. And oh,
Right.
Mike, by the way, if you need assisted living or you can't do 2 of 6 living activities, instead of paying you 16,000, they're going to pay you 32. And most of them are for 5 straight years,
Wow.
you know.
That's incredible.
So that's what the benefit of having those riders. Some of them are free.
Yep.
The payout is less. The reason you get the other ones is I'm guaranteed a high rate of growth and return every year until I turn on that income. And when I do, my payout factor is higher. So
Yeah.
there's specific fixed index annuities that are literally designed for income.
Mm-hmm.
And they usually have those riders or that income benefit. And then we'll talk later on. There's also fixed index annuities that are designed more for safe accumulation.
Right.
Right. So anyway,
Well,
that's the
yeah, the garage just keeps expanding, and well, I think it just really begs the question or the challenge to don't try to figure this out on your own. Call Johnny, have a conversation, get a copy of his book where he talks a little bit about this, and then sit down and talk with him where he can dive as deep as you want to go. And we're not talking about a swimming pool. We're talking about annuities and guaranteed income for life and all the different benefits. And do you just need accumulation? Do you need income? What do you need for your specific situation? And Johnny has this big toolbox to work on all these vehicles, and he's going to put you in the right vehicle for your family. And it's not something you're going to learn on a podcast. You can get an idea, you can get some education on this on his best-selling book. But until you sit down and talk with him, that's really where it's going to happen when you start
and
wrestling with it.
yeah, and real quick is it's like, well, but man, is that fee worth it? I think it is generally for
Oh
most
man.
folks, but that's up to them. But the bottom line is if your money's in a brokerage account or something or
Yeah,
401k or wherever it is, you're already paying a fee.
that's right.
Now, what is worth it? Okay, it's okay to pay a brokerage fee because we do this too for people to manage their money, you know, but I'm paying a fee over here for hopefully a good return. Could be bad. It, you know, over here I'm paying a fee for that peace of mind,
That's
for
right.
that guarantee.
Yep.
So I'm using my funds and I'm having that fee just came out of my account, that 1% or whatever it is, but it provides me something that gives you peace of mind. So no matter where your money is, in a
Yeah.
CD, there's, if you try to take it out early, they charge you a fee or whatever. So the fee in a fixed index annuity does something that's designed to benefit you and hopefully put you in a better position if we utilize it, put you in the right product. If you don't need an income stream, we're not going to put you in an income annuity.
That's
We're going
right.
to put you in an accumulation. But if you need a guaranteed income stream from 12 months, some of them might let you do it from day one, by the
That's
way.
crazy. That's
You can put the money in there and start drawing the income. But
yeah.
if that's your goal, we go with that product. And the cool thing is we work with so many different carriers. They change their rates, they change their bonuses because they're so competitive all the time. Man, we can find out based on your age and what you're doing, this carrier now, this company now is offering the best thing for you personally.
Right.
So a 63-year-old may not get the exact same one that a 70-year-old does with the same, it
Right.
might be a totally different company because it's all different. So we're not
That's right.
beholden we don't, as a fiduciary, we're not beholden to any particular company. We try to put you in the best case and the best carrier for you based on your situation. So,
Right. That's why it's important to sit down and have those conversations because there are lots of opportunities and lots of moving pieces. But schedule a call with Johnny at retireatnewheights.com and you can get his best-selling book there. You can talk about different types of vehicles to accomplish your financial goals so you can retire at new heights. Johnny, thanks for another great episode. Can't wait to come back and dive in a little bit deeper.
yes, sir. We'll see you soon.